Lonsec wishes to remind that the information we provide on our portfolios is general advice, and we encourage investors to read the PDS or seek professional advice prior to making any decisions on their investments.
Hi, I'm Martin McGrath from Financial Edge Group. Today, we're fortunate enough to be sitting down with one of the experts in the industry. We work very closely with Lonsec, and we're fortunate to have Lucas to help kind of answer some questions about what's happening in the market at the moment. And so let's dive into some questions with Lucas. Our specialization is in retirees, and we use a certain bucket approach to make sure they've got cash reserves to allow to kind of focus on markets ups and downs. That even if you're retired, yes, you want to be more conservative, but you've got 20 or 30 years that you want your money to last for. So your diversification point of view is bang on, and we focus on that. But in that, let's say that if different clients, it's different, might be 10, 15, 20%, we're in cash or fixed interest. We are in a low interest rate environment. In terms of, I suppose, part of that, we get you guys involved to help manage that. But in terms of trying to get a return in a low interest rate environment, and people just accept that we are getting lower return but lower fee or risk, where your perspective of interest rates and how to get a return in this kind of environment on the defensive side?
Yeah, it is in terms of that defensive side. So you get little reward for holding cash in terms of returns at the moment. We all know that, and even on fixed income, it's challenged at the moment. So from our perspective, when we're thinking about, like if you sort of rank order, okay, where do we think, just more broadly, you're still going to get a return. We still do think that your growth assets, equities, for example, you're still being rewarded for taking on that risk relative to cash and bonds. The dilemma within less so cash, but say bonds, is what level of risk do you want to take? So we've always sort of been of the view that equities, people sort of tend to understand. Equities, you take on risk. Equities can be volatile, and that's pretty clear. Within bonds, obviously, it's a very broad church of assets. You've got assets that are pretty conservative, but then you've got assets that, arguably are very high risk. And from our perspective, you don't want to be just chasing high returns in fixed income, because as you take on and you go up that risk curve in terms of fixed income, they do behave more like equities. So you're sort of doubling up on that equity risk. So what we are seeing though at the moment is it does pay to be active in that fixed income part of the world. I mean, just interestingly, the month of October, global bonds, for example, the benchmark returned -3%, and that is because the what you did see is 10-year treasuries basically go up. It's in a perverse way, when those things go up, it actually is not a good thing for bonds. So it's a bit in reverse. Yeah. But the reason I point that out is that from an active perspective, we did see a lot of the active managers do relatively well against that benchmark. So it is an environment that we would argue you need to be more active in your allocations to bonds. And the market does move. So maybe if I use one sort of example, and for retirees, when we had that sort of in the depths of the COVID period, and if some of your clients may recall, last year, and the markets, went down, when it was sort of everything was, the markets locked up, COVID was in train, and markets went south. Interestingly, and at the same time, clients may remember that a lot of Aussie companies halted their dividends or reduced their dividend payment amounts. And so in that environment, it's like, well, where are you going to get income? And with every sort of downturn in market, opportunities come. And there were certain parts of the fixed income market that were generating incredible returns and opportunities for clients, and the ability to be active. And those opportunities closed up. But I guess the only reason I say that, it is an environment where you have to be more active in your approach, because just the set and forget in this environment probably doesn't work as well.